Welcome to The Explainer. Today we're tracking a story that connects a single decision by the Federal Reserve to a multi-trillion-dollar ticking time bomb in Japan. And most importantly, we're going to explore what it all means for what could be a massive global wealth transfer. All right, let's get into it.
So, just a few hours ago, the Federal Reserve cut interest rates. Now, I know, on the surface, that might not sound like a huge deal. They've done it twice already this year. But trust me, this time was different. Very different.
Because what if I told you that while everyone was watching the Fed, the real story, the one that truly matters, was actually unfolding halfway across the world? A story with ripple effects that could touch everything, from your 401k to the price of your house.
To really get what's happening here, we have to start with just how strange this rate cut actually was. You see, the Fed, well, they essentially made this massive decision completely in the dark.
Think about the context here for a second, because this is what makes it so wild. For the very first time in history, the Fed lowered interest rates without any inflation data to guide them. On top of that, the October jobs report got canceled. That means the people in charge were literally flying blind, with no real-time way to measure the economy. So that begs the question, why on earth were they in such a hurry?
Well, the answer might just be hiding in a corner of the financial world that most people have never even heard of. It's a mechanism that quietly moves trillions of dollars around the globe, and it's called the Japanese carry trade.
Now, I know it sounds super complicated, but the idea behind it is incredibly simple. For the last 30 years, Japan has kept its interest rates right around zero. And that, my friends, created a massive, and I mean massive, opportunity for investors everywhere.
Here's how it works. Step 1, you borrow a ton of Japanese yen for practically nothing. Step 2, you swap that yen for US dollars. Step 3, you buy safe American bonds that are paying you, say, 5%. And Step 4, you just pocket the difference. For decades, it was basically an almost risk-free profit machine that pumped trillions of dollars into global markets, pushing up the price of pretty much everything.
But here is the absolute crucial point of this whole story. After 3 decades, that machine is starting to grind to a halt. In fact, it's starting to go in reverse. The tide is turning, and it's turning fast.
You see, in an effort to kickstart its own economy, Japan has started to issue stimulus, and because of that, its interest rates are finally, and pretty quickly, starting to climb. And that one little change? Well, it changes absolutely everything for that trillion-dollar trade.
So here's the reversal in action. Before, borrowing money in Japan was dirt cheap, so that cash flooded out into the world, pushing up asset prices everywhere. But now that borrowing costs are rising, those investors have to unwind the whole trade. That means they sell US stocks, they sell crypto, they sell bonds, and they send all that money rushing back to Japan to pay off their now more expensive debt. And that, of course, puts serious downward pressure on our markets, even if the US economy itself seems totally fine. Okay, so that's the big, kind of scary macro picture. But let's bring it home. How does some complicated financial trade in Japan actually connect to your investments, your savings, and the value of your house?
You know, there's this huge misconception out there that when the Fed cuts rates, it's always great news for the stock market. But honestly, history tells a very different story. The Fed doesn't cut rates because everything is awesome. It cuts rates because it sees trouble on the horizon.
I mean, just look at the last 3 major crises. In 2001, the cut started right as the dot-com bubble was bursting. In 2008, rates fell right in the middle of the financial crisis. And in 2020, they dropped rates just before the big economic shutdown. The rate cuts didn't cause the crisis. They were a response to the storm that was already brewing.
And you know, even with all these scary headlines, it's so important to remember that market volatility is completely normal. A decent-sized market correction, something around 15 or 16%, happens on average every 16 months or so. It's not a sign that the system is broken, it's actually a feature of a healthy market.
So what's this doing to specific assets? Well, it's been a weird year, right? Gold is having a really strong run, but Bitcoin is actually on track for a loss. And if you just look at that, you might think, well, so much for Bitcoin. It looks like it failed.
But here's the thing. When you zoom out, this current drop fits right inside its historical pattern. Over the last 15 years, Bitcoin's had 6 major drops of between 50 and 80%. So a 40% decline, while yeah, it's painful, it's really not that unusual. It's often just driven by too much leverage getting washed out of the system, not some big fundamental failure.
And you know, the housing market is telling a very similar story of two different realities. On one hand, you've got homeowners who are locked into these amazing 3% mortgages. They can afford to wait for the perfect price. But on the other side, you have people who bought more recently at higher rates. If they have to sell, they have to be realistic about their price. This creates a split market where some houses get snapped up while others just sit there until the price comes down.
Okay, so let's pull all these threads together. We've got the Fed's blind rate cut, the unwinding of Japan's massive carry trade, and all this volatility in our markets. They're all connected to a much, much bigger shift that's happening right under our noses.
Because maybe the most important move of all, and the one nobody is really talking about, is that the Fed quietly decided to stop its policy of quantitative tightening, or QT.
So what does that mean in plain English? It means they stopped pulling money out of the system. In fact, they started putting it back in. They announced they're going to start buying $40 billion in U.S. Treasuries. So get this, while they're cutting rates with one hand to signal caution, they're reopening the liquidity spigot with the other.
Look, in an environment like this, where things are changing faster than the data can even keep up, it's the simple fundamentals that matter most. We're talking about having an emergency fund, protecting your income, investing consistently over the long haul, and probably most important, not making emotional decisions based on scary headlines.
And this quote right here, it just frames the stakes perfectly. We are truly at a crossroads. For people who are prepared, this moment could become one of the greatest wealth transfers we've ever seen. But for those who are over-leveraged and unprepared, it could be absolutely devastating.
Which really leaves us with the one final big question. Are all these moves by the Fed, the rate cuts, ending QT, injecting liquidity, are they designed to stabilize the system and give us a soft landing? Or are they just trying to soften us up for a much bigger impact they know is coming?